This is a continuation of the previous video in which we did one journal entry. So I'm going to continue with the second journal entry. So we are going to transaction 2, which is borrowed from bank. So let's switch on to transaction 2. We're going to follow the same process in baby steps. Identify the two accounts involved. Now, let me again populate some options based upon my experience. When you borrow from bank, there is a borrowing account. There is bank involved, so there is bank account. And some people also say this is a loan account as well, right? And then I do get this as well. There is a liabilities account. Okay, so another quick tip, when you have the name of an asset, liability, income or expense, you use the name. Do not use the generic term, which is name of a category. There are different types of liabilities. Do you know the name of the liability? If yes, then you use the name, not the liabilities. And in this case, we do know the name. I'm going to strike this off right away. Okay, then you borrow from bank, you go to the bank, the business goes to the bank. You represent the business as the owner or management. You go to the bank, you say we want a loan, submit the paperwork, bank processes it, and then bank deposits 200 in the bank account of the business. So certainly bank account of the business is involved here. So I'm going to check this bank account. Number one. Then borrowings and loan essentially indicate the same thing, and we do not have any specific account called borrowing account. Again, borrowing is a generic term. Do you specifically know, what the name of the loan is? The loan could be a working capital loan. The loan could be for the purchase of building. So you can specify that as well. So here, the typical nomenclature is you write the name of the bank. You've taken a loan from SBI. So you're going to say SBI loan account. It represents the borrowing that we have taken. So again, this is a generic term. I'm going to cross this off. So you have two accounts, bank account and SBI loan account. The next step is the nature of accounts involved. So you have bank account, SBI loan account. The bank account, as it was in the previous journal entry as well, it's a real account. SBI loan, it's a liability. It's a liability, and hence we're going to call it a personal account. And bank here was an asset. I did not write it. Let me just asset, and this is a real account. How is SBI loan a liability account? I think these discussions we've had, and this should be absolutely clear. If you have any doubts whatsoever, go back to the previous videos where we discuss in detail each of these items as to should they be called an asset, liability, income or expense. Alright, having identified the two types of accounts, we have to figure out the rule of debit and credit for these two types of accounts. So for real account, debit what comes in. Again, I'm writing in further shorthand, and credit what goes out. Personal account, debit the receiver and credit the giver. These are the two rules. Now, the business is getting money in the bank account. So bank account being the real account is coming in. The asset, new asset is coming in. So you have to debit the bank account. I'm going to write it here. Bank account debit. And the other account, of course, is SBI loan account. So SBI loan account is a liability. And this is, again, the loan liability represents the bank. And bank, in this case, is the giver of the loan. So that's how you have to read this. So credit the giver. SBI loan account credit. There you go. You write 200 in front of the debit column, debit row, and 200 in front of the credit row. The reason I stagger these is because this is how the format of journal is. If you remember from the first phase, maybe I'll quickly show it to you here. You have debit amount and you have credit amount. So you have to write it like this. And since you have a debit item here, credit item here, I'm writing in front of this, writing in front of this. That's why the so after we go through these transactions, I'll show you a final journal how it should look, and then things will become more clear with respect to the presentation of this. And you don't have to write all of this. This is only for learning purposes. You eventually write only this journal entry here. Let's go on to another transaction. Purchased goods for cash. Let me identify the accounts. So we have purchase account, right? There is goods. Let me write goods account. There is cash. Let me write cash account. Okay, I don't see anything else. However, you purchase goods from a vendor, right? From a vendor. So let me just add that to improvise. So I'm going to write vendor's account. And if you had name of the vendor, for example, ABC Limited, I would write that ABC Limited account. Okay, accounts involved. Let me now try to eliminate and identify which two accounts are the correct accounts where the transaction should be written. Okay, let me go from bottom to up. Vendor's account. You are purchasing goods for cash, number one. When you are purchasing goods for cash, you are paying the vendor in cash. Okay, when you pay the vendor in cash, you don't need to worry about writing it in a notebook that you have paid this person in cash. You only create a record for the vendor if you have to pay to him, or any other business if you have to receive from him. So any cash transaction, we do not worry, do not bother to record it in the account of the person with whom transaction is being done. If it is cash, we just take cash account. So cash account is certainly an account, but vendor's account I'm going to eliminate because we have paid to the vendor. No more liabilities, no more recording. The other two options are purchase account and goods account. And I told you that purchase account is reserved for the goods for resale purposes. Resale purposes. We don't use purchase account for purchase of assets, only goods, which means purchase and goods are the same thing, and we do not maintain any goods account. There is no goods account, right? There is unsold stock which becomes a current asset, but its treatment is different. It does not feature here. So purchase account is the other account. Purchase account has inherent in itself the goods account. What are you purchasing? You're purchasing goods. So you don't have to worry about these two accounts. So identified, you have purchase account and you have cash account. And since we set a rule that all transactions are going to go through bank, we are going to replace cash with bank account. So although the transaction says purchase goods for cash, cash has been deposited in your bank, right? So basically cash would reflect that payment is done. So instead of cash, I'm going to now write bank account. All right, what is the nature of these two accounts? The purchase account is an expense and hence a nominal account. On the other hand, bank account, as we know, is an asset and hence a real account. Okay. Oh, I messed up a little bit. Don't mind that. So I should have written all of this in the section above. The rule of debit and credit. So nominal account, the rule is debit all expenses and losses, and credit all incomes and gains. Incomes and gains. For bank account, real account, debit what comes in and credit what goes out. So these are the two rules that we have to follow. So Purchase being an expense has to be debited. Debit all expenses and losses. So I'm going to write purchase account debit and bank account. On the other hand, you are purchasing and then you're paying the vendor through your bank account. So bank balance is going out. It is reducing. That's how you should see it. So bank account credit because bank balance is going out. So these two rules are being used here. You use amount 50 and 50 for debit column and credit column, and you're done. There you have it. The transaction for purchasing goods in cash. Transaction 4. You purchase goods on credit. Now you do not pay and you are buying it from ABC. Okay, ABC Limited is our vendor now. So step 1, what are the two accounts involved? We will have a lot of options here. So again, purchase account is involved. Goods account could be involved. There is a credit. There should be a credit account that is involved. And then 50, this money might have been exchanged. So bank, all transactions are through bank. So I'm writing bank account. And finally, you have ABC account. There could possibly be a vendor's account. I'm writing all possible options that you might think of. Okay, and now I'm going to eliminate some of these to arrive at the final two. Vendor's account. Vendor is a generic name. When we have specific name, we don't need generic name. The specific name of the vendor is ABC Limited. So I'm going to strike this off. You don't need to maintain a vendor's account. You maintain ABC Limited account if you have to. Okay. Let me then pick goods. We discussed in the previous transaction that purchase account is reserved for the purchase of goods. So when you say purchase account, it is goods account. So you don't need to maintain a goods account separately. So we strike it off. Then there is credit account. Now, we've never discussed a credit account. We've not seen a credit account in the balance sheet or income statement of Reliance Industries Limited either. So there is nothing, as named as credit account. No. If you were trying to say that we have purchased goods from somebody and there is a liability, then that's a creditor's account. But again, creditor is a generic term. The vendor is the creditor. So vendor is also generic term. Finally, you have the name of the vendor, which is ABC Limited. So use that name. ABC is your vendor, is your creditor, is your supplier. So everything has been included in an account which you can call ABC Limited's account. This account represents all the things that you wanted to represent from the liability side. Okay. So now you have purchase account. Purchase account certainly because you are purchasing goods, so you have to. So the only thing which is now left is bank account. Should bank account be involved or not? Well, you are purchasing goods on credit. You're not paying to the person, so bank account is not getting affected. So let me cross the bank account as well. So there you go. You have the two accounts: purchase account and ABC Limited's account. Okay, there's a book. We're going to write all the purchase transactions. There is a book. We're going to write all the ABC Limited's transactions. What is the nature of these accounts? Purchase is considered an expense. Therefore, it is going to be a nominal account. ABC Limited, on the other hand, is your creditor. Is your creditor, it is a liability. All liabilities are personal account. What is the rule for nominal account and for personal account? For nominal accounts, the rule is debit all expenses and credit all incomes. Okay. And for personal accounts, the rule is debit the receiver and credit the giver. Now let us see, purchase is an expense. So purchase being an expense will be debited. So you write purchase account debit, and on the other hand ABC Limited being a personal account, and being a giver of the goods to the business will be credited. So we are going to write ABC Limited's account credit, and amount is 50 and 50 here. Done. That's it. That's how you record a transaction which is on credit, which is not on cash. Let's look at one more transaction. Sold goods for cash. Now you're selling the goods. The two accounts involved clearly could be sales account, and goods are being sold. So you could say goods account. And then you might wonder, hey, goods account was represented by the purchase account. So maybe purchase account is involved. So we'll write purchase account here. And then there is cash account. And possibly there is a customer. You sold goods for cash to customer. So there will be a customer account. Okay, now pay attention about these three items. We said when we purchase goods, so goods are going to be purchased and then goods are going to be sold, and finally there will be goods which will be unsold, right? All the goods that are purchased are written in the purchase account. Then all the goods which are sold are included in the sales account. I should say sales account here. And finally, all the goods that are unsold go to unsold stock account, which is a different kind of account opened at the end of the year. You just have this record that these many goods are unsold, and you convert that into a current asset. This becomes a current asset later on. So and I've explained this earlier as well. 100 units can be say purchased, and then you're able to sell only 80 out of these, so 20 are remaining. So the cost price of the 80 units which are sold, 80 units are sold at, let's say, 100. This becomes your revenue. These 80 units were purchased at, let's say, 90 rupees. This is your expense for the year. And finally, the 20 which is unsold, 20 into the cost price again, 90. This is the current asset. This is the unsold stock, current asset. You have to understand this dynamic here because this is going to be used as we move forward. So in this transaction, what is happening is you are selling some goods for cash. So you are selling some goods here. You must have purchased these goods earlier, and we saw that. So the goods account is of two types then: purchase account and sale account, expense and an income account, revenue account. Okay. So here there is no separate goods account to be maintained. There is no purchase account which is getting affected in this transaction. Okay, although they're the same goods, but you maintain separate records. And as we move forward, it will become clearer as to why we keep purchase and sale separate, despite both representing the same goods. And then you have cash account. We agreed that we will do all transactions through bank. So I'm going to replace cash account with bank account and cross it off. And you have customer account. Now you sold goods to customer, he paid you cash. Well, you don't have to bother recording transactions in his account. Therefore, you have bank account and you have sales account. These are the two accounts which are involved in this transaction. Bank is a real account. I think we've done this over and over. Sales, being an income, is a nominal account. For real account, your rule is debit what comes in and credit what goes out. For nominal account, the rule is debit all expenses and losses and credit all incomes. The bank here, is going up because you're selling goods, cash is coming into your bank account, so bank balance is coming in, so debit what comes in. So the journal entry is going to be bank account debit. And on the other hand, you have sales, which is an income and it's a nominal account. The rule is credit all incomes and gains. So we're going to write sales account as credit. The amount is 50 and 50 for both debit and credit. There you go. That's how you generalize the transactions relating to sales of goods in cash. Let me take another transaction of sales where you do sales on credit. When you sell goods on credit, and I'm going to put out less options now, be more refined in my approach. I know that whenever you sell goods, a sales account is involved. This represents the goods that are being sold, and goods are being sold on credit. You're not getting cash, so bank account is not involved, and the goods are being sold to a customer whose name I know, which is PQR Limited. So I'm going to write the name of the customer only, PQR Limited's account, and the value of the goods is 50. So this is how the thought process, your thought process is expected to evolve. You should be able to, identify the accounts involved very quickly with clarity. So sales are happening and PQR is the customer. We are writing in the PQR's account because he has not paid us money, and he has not paid us money, therefore we are not writing bank account or cash account at all. Now sales account is an income, hence it's a nominal account, and PQR Limited's account. Now this is your debtor, this is your customer. So let me spend a little bit of time here. This is your customer, this is going to become your debtor, and debtor is a current asset. Rather than comma, I should use these. So current asset. A current asset is being generated. The PQR, although is an individual, he owes the money to the business. The business transferred the possession of goods to this customer. Now the customer is liable to pay back to the business. If the customer does not, then business can sue the customer and take help of legal machinery, as we said. So this is a current asset. You expect to recover this money within next 1 year. PQR Limited, this becomes an asset. It is a debtor, and hence it is a real account. So people get confused, calling this a real account because this is PQR. This is a person, who is involved here. We could also use that logic, but let me complete it using this logic, because we treat PQR Limited as a debtor, as a customer, as a recoverable amount. So we treat him as a real account, as an asset. So the rules for nominal account. Rule for nominal account is you debit all expenses and losses and credit income. So I'm going to only write this rule, credit income, because I know there is this income. And second is real account. For real account, the new asset is being generated. The new asset is coming into the business. So debit what comes in. There you go. So we're going to write PQR Limited's account debit and sales account as credit, 50 for both debit and credit. So one thing you should notice is that we typically write debit in the first line and credit account in the second line. That's a convention that is followed. Wherever you look, you have the account being debited first, followed by the account being credited. Now let me clarify the other doubt where this is an alternative to this, where you say this is a personal account. This is an artificial legal person. So this is a personal account. If you call it a personal account, then the rule for personal account is going to be debit the receiver and credit the giver. PQR is the receiver of the goods. So I'm going to write debit the receiver. So even using this logic, you will debit the PQR. So you will arrive at the same conclusion. However, I suggest that you always treat your debtors as assets and then real account. That's easier to follow, keeps things clean. Only the liabilities should be considered as a personal account. Again, you will not be violating any rule because you still get the same conclusion, and the logic, it's logical as well to consider it personal account sometimes, but follow one method. If it is an asset, treat it as a real account. Okay, let me stop here. There are more transactions that we'll take up in the next video, which is continuation of this one.